The tariffs may be starting to hit our wallets. It's Tuesday, July 15th, and this is Markets with Megan. If you like this podcast, please subscribe. You can hit that alarm bell. Also, share it with friends, family, or colleagues. But we're here today to give you a little bit of a recap of what we saw this morning from an inflation standpoint. Remember, the Federal Reserve kept interest rates on hold last month and continued to say that they would wait and see how the tariff impact unfolded in the inflation data. And you're going to see a lot of headlines that inflation came in a little bit weaker than expected. Inflation seems tame. We're not really seeing a tariff impact. Let's be careful there, jumping to conclusions before we dig into the details. So let's look at this report. First of all, on a headline perspective, so this includes all of the factors in the consumer price index. This was a little bit, it came in as expected, but it was higher than last month. It rose 0.3% versus 0.1% last month. That brings the year-over-year growth rate to 2.7, slightly higher than expected and much higher than it was the prior month, which was 2.4%. Now, we can equate that big jump there to primarily energy prices that were up significantly in the month of June. But let's take out those volatile energy prices and the food prices and look at the core level. This is what the Fed likes to look at because it is less volatile, and this is where we see some of the sticky inflation indicators. At the core level, on a month-over-month basis, it rose about 0.2%, a little bit higher than the last month and a little bit lower than expected. But let's look at the numbers on a year-over-year basis, which is what we look at and what the Fed likes to look at as well. It's growing 2.9% at the core level. That's versus 2.8% in the prior month. So again, a little bit higher. The markets, like I said, the headlines are focusing on that this wasn't bad. It wasn't bad, but it's not going in the right direction either. We are looking at tariffs showing up in things like whether you look at apparel, you can look at appliances. Some of these prices we're seeing get that impact from tariffs, and we haven't necessarily seen what the tariffs are ultimately going to be. Again, that's been kicked down the road. So our concern is that this is a problem going forward into the second half of this year and is probably going to keep the Fed on hold through to the September meeting. Now, when we look at really the true core, where we spend the majority of our money on the service sector, when you take what the consumer price index at the service level and you take out energy, take out that volatile component, that's rising about 3.6% on an annual basis. That is substantially better than what we saw in 2022. It was about a little over 7%, but at 3.6% year over year, it's still growing above the historical average and above that the Fed's comfort zone. So that's something they're watching closely. We're seeing the reaction in the markets today where equities are down. They are concerned about the rise we're seeing in interest rates. The 30-year Treasury has now intraday gone above the 5% level because the Treasury market's again concerned about future inflation and what we may see over the next few months as we try and round out this year with the tariffs that will go into effect in the second half of this year. That's all we have today. If you want a history of this podcast, you can go to marketswithmegan.fm. Thank you.